All right, we're live. Welcome everybody to the Bootleg Weekly podcast. This is the podcast where we protest Tanner, and naturally, we have a special guest. And we figured if we're going to protest Tanner in this Bootleg Weekly, we're going to have our own Bootleg Tanner. Sam, welcome to the podcast. What's going on?
That's why Tanner's not here, man, is because I actually am Tanner.
We have better Tanner.
We've never seen Tanner and Sam in the same spot. So, I mean, maybe different lighting, you know?
I mean,
that's true. No, it's super cool to be here, man. Thank you guys for having me. And yeah, excited to talk about stuff.
Yeah, it was really interesting to, get you on because I know you haven't done any YouTube appearances or streams in the past. And the stuff that you're posting on X is like brilliant for SoFi, for PayPal, for quite a few other names that I think we overlap on. So
Thanks,
really excited to get you on and have a chat around. We have some like stacked topics for tonight. So this is going to be fun.
And real quick, definitely. Guys, you see Sam's handle is right there. He really is a great follow. So newer to the X platform, and he picks out stuff like I think I know PayPal pretty well. He'll pick out stuff that I've like never even considered. SoFi pretty well, and he'll again hit that all the high notes and just it's free. I mean, like just subscribe, dude.
Thanks, man.
Okay, so let's jump into this. The main topics that we have for today are the Apple lawsuit. So Apple versus the DOJ. We have the Elon email for FSD and just talking about Tesla's comeback in general. Of course, we have Robinhood Gold and that whole announcement, which we're going to talk about versus SoFi. And then maybe we talk about DJT for a little bit, and then we can just talk about whatever we want after that. What do you guys want to start with?
I'm good to jump into the Apple stuff if you guys want, man. I think that's an interesting topic to kind of get into.
Yeah, sounds good to me. Let's do it.
All right, so kick it off, Sam. Like, what's the backstory?
Yeah, man. So basically, the federal government is suing Apple. Basically, antitrust lawsuit saying that they're creating a monopoly for their own product, which anyone in the developer community kind of understands that the Apple walled garden has been something that's been huge for the last decade, at least. Myself, being in software development, I wanted to build an app for education that would require people to interface iPad scribbling basically with a Linux server. And trying to get this supported was just hell. I mean, Apple even has people develop apps in their own language, Swift, right?
Right.
So yeah, I think that it's something that's been brewing for a long time. Probably they've been sitting on this case and waiting until the time felt right and like they had enough ammunition. I'm not super convinced that all of their case will stick, but they definitely have some good fair points in there.
I don't think any of their case will stick, honestly. So just for further backstory, the DOJ has been holding on to this case for many, many years. They've been, I think, gathering evidence for this case for like a decade or so. And I would understand if this was an attack against the App Store specifically, but it's not. It's mostly an attack against like the hardware ecosystem. And so the things that they had in this suit were the blue text bubbles for Apple devices. They blame Apple for like Amazon Fire Phone failing, all the way down to, CarPlay specifically. And there's so many old arguments that they're just recycling, and even arguments that Apple has actively addressed and rolled out fixes for. It's just this case is so old and they're just recycling all these arguments. It almost feels like they just had the arguments already like ahead of time, and they're just going ahead with a case anyway. So if anything, it's probably going to be mostly a perception thing from Apple. It's negative press, but I don't think that anything will really stick. I mean, I think Apple's had like 3 or 4 cases, massive lawsuits like this in the last decade or so. They're used to this by now. It's the DOJ has changed their case 6 times in the last 4 years. They're just looking for an excuse to sue them at this point.
No, I agree. I mean, sorry, Roy, if I see anything sticking, it's probably more on the side of cross-platform capabilities, right? Like, sure, they're going to be able to lock in people via the Apple Watch, right? There's probably not much that's going to happen there. But as far as allowing content to work correctly on cross-platforms, I feel like that even if an actual legal case doesn't stick, bringing some change to Apple in that manner would be good. What do you think, Roy?
Yeah, the piece that I think actually will stick, and possibly two pieces. And by the way, before we go there, this was probably the funniest part. And Tevis noted this that they're actually blaming the failure of Amazon's Fire mobile phone in 2014 on Apple. And it's like, come on, like you said, this is something that they've been collecting evidence for probably a decade. But there is a relevant piece here, and what that is the near field communications NFC chip. So just for some clarification, the EU actually sued Apple successfully for that reason and other reasons as well. And Apple ended up settling that, and they're granting developers like PayPal access to that NFC chip, so you can do the click the button, change it to PayPal, set it up once, and then you just have to tap to pay. So I think that there's a good chance that actually sticks. Just with some of the other antitrust stuff that's been ongoing in the United States, and then this piece with the EU, and then possibly with the App Store, the development store side, I don't know that they'll actually. They talked about possibly breaking up Apple. I don't see that happening, except for possibly separating the App Store itself. That would actually cause a lot less friction, I think, with what people, as far as developers, are actually facing right now. But I don't know. I think that the NFC part, though, I don't think it's just hopium as far as PayPal and competing against Apple Pay. I really think that there's a good chance that they actually settle on that. So we'll have to see.
So basically, the main argument that we're saying is that the Apple Watch is not compatible across different ecosystems. It's only compatible in Apple's ecosystem. And that's like the silver bullet that they have against Apple. Am I understanding that correctly?
Well, no, the NFC chip, like, you have an iPhone, right?
I do have an iPhone, yeah.
Yeah. Have you used that before to do like Apple Pay, tap to pay? I don't know if they have that in Canada.
We don't have that. No.
You'll get it in 10 years.
Yeah,
Canada.
That's what the DOJ should be suing them for. Like, treat Canadians fairly, guys. Come on.
So, I mean, it's supposedly Apple's argument with protecting that, and that they use this for the European Union as well, as I said, that it was a security hazard if they open that up to any other kind of development. But they have a very closed ecosystem there where they prevent use anyway with all the apps that come through. You have to jailbreak the phone, which is against the term of subscription, to be able to put something on there that Apple hasn't approved. So it really doesn't make sense. It didn't fly in the European Union when it came to that. And it's hardware. They have that near monopoly as far as that NFC chip. It would be helpful, not just to PayPal and other developers, but it would break that monopoly. And it'd be very tough if they settled on that to actually argue that Apple has a monopoly when it comes to the hardware, because they're saying, hey, it's proprietary to just us. Nobody else can use it. So I think that's the main argument there is that they prevented that, and there's no good reason for doing that. And it's caused a lot of issues as far as in the payment space. And you really need that competition to be able to benefit the consumers, at least. And it's kind of the route that they also went with Amazon, although that one with Lena Khan I thought was just ridiculous. So,
and nothing came of that, right? What came of that?
Nothing. Yeah.
Well, that's the thing. Like, the government has just like lost bite. Like, they have no teeth to these arguments, and the market knows that. Nothing comes of these arguments. They sued Google, nothing happened really. They sued Meta, nothing happened. They sued Amazon, nothing happened. Like, forgive me for assuming that nothing's going to happen for this time around either.
No, you're fair to be pessimistic in that regard, man. I mean, consider the government connections at a company like Apple and the lobbying effort, right? Like, these sorts of things typically fizzle out, and that's totally fair, man. What Roy was mentioning on the NFC side, like, the digital wallet is another interesting component of the suit, because once you transition away from like tech and software specifically into now payment providing, I feel like then it becomes a little bit more important for things to be open and accessible, right? If we're going to lock up the ability for people to pay for a service or a product to one specific way, well, why shouldn't we be able to have a wallet that integrates with Apple's ecosystem? And being restrictive in that manner, I didn't mind that part of the suit.
And along with that, the one successful suit that I've seen as far as it being settled was actually announced, I believe, yesterday. That was Visa and MasterCard, which had this long ongoing battle with the anti-steering and then some rates, interchange rates as well that they were charging. And so they settled. They basically said, hey, we're actually going to reduce it to this amount. We're not going to raise it for 5 years. And they also were removing some of the anti-steering clauses. So I know we're not going that direction. That does have an impact on PayPal a bit. But it's just the payment space has seemed like that there's a lot more, there's been a lot more wins for the government and for those that are actually suing than anywhere else. So that I really think that there's a good chance that Apple, at the very least, will settle. And it will take years, no matter what, unless Apple just, for whatever reason, wants to put it to bed.
Yeah, that's the whole thing. It's Apple had a negative reaction in the stock price, which is to be expected. But this is something that's so long-winded and so dragged out, and the arguments are so weak that at the end of the day, I don't think it's a strong argument, right, against Apple. I hold Apple. I added to Apple actually this past week on the dip at like 170, and Apple's, I think, the worst performing Magnificent Seven this year. It's down year to date. So it's like, it's Apple dying. I mean, you could make a stronger argument that Apple is dying with regards to like the AI thing, or, whatever you might say, like their ecosystem, they're not innovating, whatever it might be. They spent $1 billion a year on their Apple car. Sure, I'll accept them all. But to say that Apple is, as a result of this suit, it's actually going to hurt them more than a paper cut, I don't buy that.
If I can ask, what is your push for wanting to have Apple in your portfolio today?
Oh, it's in my dividend portfolio. It's one of the only ones that pays a dividend. So Apple and Microsoft are in there. Amazon, Google, and Meta were not. I mean, Meta's paying a dividend now, but that's the only reason I had Apple and Microsoft in there specifically, because they pay out a dividend and it's more stable.
Yeah, that's fair.
Yeah.
Yeah, it's one of those that even if you don't own it, you own it. If you own anything about any broad ETFs or the index funds, it's just.
Well, so look at it this way, right? All the index funds, all the ETFs, they have Apple exposure. Apple is the highest owned stock across, Congress. Basically, all of the politicians, like Apple is the stock that they all own. And so, if you look at the incentives behind this suit, you're disincentivized to hurt Apple because you're hurting the wallets of all the people that are actually making up that lawsuit.
Yeah, fair. What do you guys think about Apple's kind of more recent pivot to also attack the Chinese market? I mean, I know they've been living well there for a while, but it seems like for example, I just saw that Tim Cook was saying, we want to push the Vision Pro headset hard in China. What do you think about that and how it could impact the business?
I mean, that's their next vector. If Vision Pro doesn't really take off, if they struggle there and it's a dud, which I think it'll be a success. Actually, I'm optimistic on it. But if it's a dud, then given what Apple, has pulled back from, so the EV, and then kind of recently, as far as those talks with AI with either Google or the OpenAI, it just seems like people will, at least a narrative for Apple will be, this company has no future growth vectors. I don't think that people think that it's dying. Like they do have a large moat, and if they die, it's like 30 years from now, right? But I think it'll be priced accordingly, and we'll have that at the same time as Apple's always been perceived as a place to go in a time of risk, and so that's a flight to safety. And we're going, and I think more risk on as the time goes on. So I think Apple actually might tank harder than Tesla for this year. Long term, though, if the Vision Pro takes off, they absolutely have to be selling in China and getting that pushed out. There's a lot of wealthy people in the United States, but there are elsewhere in the world, and they really need people adopting that. And as they do so, there'll be more and more developers that actually want to build on that. If it's successful, it'll be wildly successful. So
there's no way that Apple is going to tank more than Tesla, man. Like you can forget about that. Tesla is like 34%. Like Apple doesn't do that in a recession. Like you had like 2020 and it barely fell, 34%.
Okay. We got to talk Tesla next then, because I don't think Tesla will stay at this point for the rest of the year.
It's going to recover. I get it. But I'm just saying, like, Apple is a flight to safety for so many people, and people are flying out of Apple because the market is, on a bull rally. And I get that. you want to take your money out of the piggy bank, which is Apple, and you want to allocate it to Clean Spark and YOLO it because the market's going up. I get that trade. I understand it. But my point is like Apple is so widely owned, first of all. And second of all, it's still yet to be seen, right? Everybody thinks that Apple is going to go out of business because they haven't really had the preliminary, news around AI. Vision Pro is yet to be determined. The initial reception was fairly high, number one. Number two, WWDC was announced, I think June 10th to June 14th is when it's going to be. I'm pretty bullish on that. Tim Cook in the last earnings call said that they are going to be working on AI. They just bought an AI company. I think that we'll see what happens with the newer models. I mean, it's the version 15, so I'm expecting like some type of change. It's not like 13 going to 14. I don't know. So I think that there's reasons to be bullish. Obviously, there's reasons to be cautious as well. But the playing field remains pretty open for Apple. It's not like if this was the end of the year and they had announced what they were going to announce and it's unimpressive, then yeah, sure, I get it. But we still don't know. And there's still that possibility that they can knock it out of the park.
My take on Apple did kind of shift over the past year or so. And the reason being is I watched Apple for years just produce essentially the same iPhone repackaged every year. And I don't know if you guys saw it come across. I can pin it for anyone watching, but there's this nice interview from Steve Jobs talking about how tech companies die when they become sales and marketing companies. And under Tim Cook's guidance, I was watching Apple become a sales and marketing company. And that made me really bearish on the future prospects of Apple growth. But the Vision Pro headset, just looking at how much actual novel tech we saw in that thing and how well it performs, yes, it's expensive, but it was super good to see Apple pivot back into innovative products. So that did change my thesis on Apple a small amount.
Yeah, it feels kind of like a prototype, just like with that external battery pack and everything, but it's very expensive. But I mean, it's a prototype that'll sell, that'll get an interest, and they have to. I mean, there's almost nothing to do with it, so they have to build out that community. So it felt very Apple-esque of old, and that actually, I agree with you, Sam. Like I before was like, hey, I think Apple may have trouble in the future, that they've not been able to innovate for a while, and here they come out with this product. So yeah, there's still life in it.
All right. But let's switch the topic from app. Sorry, go ahead, Roy. Finish your thought.
No, I was gonna say, but let's talk about Tesla, man. Let's talk.
All right, let's switch because these degenerates in my chat don't like talking about their grandpa stock. They want to talk about the fun stuff. Or we want to go to Tesla next?
Yeah.
All right. So basically, Tesla's my biggest position. I don't know, Sam, if you own. You said you had a Model 3, right, or Model Y?
Yeah, so we have a Model 3. We have the 2022. We're waiting. We don't have access to the new full self-driving, the 12 Plus, but I want to check it out. I hear it's really good. And then as far as Tesla stock, I'm not long Tesla stock. I sell some premium there on the bullish side. But yeah, we own a Model 3.
And Roy, you're actively building a position. Did you buy more, Roy, this week?
I did, yeah. Almost every week, since the start of the year. I think a little bit less in January, maybe just about 1 week in January, but I'm pretty low on cash. So this may be the last week for a couple of weeks until more money hits the account. So we'll see.
So what here makes you want a long Tesla, Roy? And I guess Tevis as well, as you said, it's your largest position. What is the compelling factor of I want to own this stock at this price? It's like what, 170 right now?
I think 180. It had a good couple days, but the main thing is it's a long-term thesis. So I think short-term, very well could be dead money for the next 6 to 9 months, 12 months maybe. But the next growth vector, which we'll talk about here shortly, is full self-driving, and it's kind of a misnomer. It's not. I mean, you have full self-driving, right, Sam?
Yeah, but we don't have the new version yet. Yeah. But even the current version, we're on 11 point something. And I mean, this car, like the other day, this car drove me to the grocery store and back, driveway to parking lot. And I have to acknowledge that, hey, what could this look like in a decade? Is there robo taxis? Is this something where, someone goes out drinking and they can say, oh, my car's just going to drive me home. I'm going to sit in the passenger seat yeah, it's within the realm of possibilities.
Yeah. So EVs, I see they just own a monopoly. I mean, no, I know there's Chinese competitors and there's a few here and there, but they're going to own the lion's share of that market. They're going to be Toyota basically of EVs, and competition is actually not bad for them. Of course, they have the North American charging standard, the NACS, that now that they have, and so they'll actually benefit from competition somewhat. Their energy sector, I'm very bullish on. Though this year, I mean, rates hurt them. Rates kind of hold them back. They're a cyclical stock, and if I've always been interested in Tesla as a position, I missed buying it at 101 because I was waiting for 100. Honestly, like I was going to load up at that point, and so I started buying in the 140s. I'm like, I'm not doing that now. Just from the beginning of the year, I'm like, hey, I still believe in this position long term. Bots, of course, are another vector. Bots, I think, will happen. I think there's going to be more competition in this space if they won't have the gigantic lead. But that's a huge, huge industry. Robotaxis, you mentioned, and there's a few other vectors going to. There are wild cards. Political, if Trump is elected and the EV tax credit goes away, and of course we remain higher for longer, that just pushes things out a bit further. But I would prefer if we're stagnant for a year and a half. And it's dead money and I miss out on some gains, that's fine. I would rather do that than miss out on Tesla entirely. I think that this is going to be one of the strongest companies in a decade's time. And it's hard for me to see any outcome where that's not a reality.
Yeah, it's fair, man.
I think for myself, it's my largest position because I've been accumulating it for a while. 2019, 2020, it's ballooned. There was a point where I was just buying Tesla every single week, every single paycheck. And, you guys named all the sexy stuff about Tesla, bots and full self-drive or robo-taxis. It's like, guys, just look at their production ramp. Look at, every year they have a new gigafactory. Every year they're producing millions of cars when last year or 2 years ago, they were producing hundreds of thousands. Like this company has such a high runway, and at the end of the day, you have secular growth trends with governments that are moving away from gas like ICE vehicles and mandating EVs as a whole, and so that's in addition to all of the other stuff like the robo taxis and the robots and the stuff that's further away, like Tesla's executing today. So obviously that's good. 2024. What year is it? 2024. It has been a little difficult because of the margins, because of that hangover period essentially that we had. The previous years were a little difficult because of the supply chain issues that we had. But I do really think that, now they rolled out the Cybertruck, they're reaching scale on that. They, of course, have to reach that critical mass before they can improve the margins on that product. Towards the end of the year, we should get like a Model 2 type of product. And what's interesting is that every single year throughout this entire thread, Elon's been saying full self-driving is around the corner. And it's, sometimes it is, sometimes it's not, but it's getting there.
Around the corner. But like, honestly, I don't know, with what happened with 12.3, I've actually escalated my buys. I basically doubled my buys that I've been doing each week. And now I got to wait for cash. Good problem to have, I guess. But the response in the community, because I've been following Tesla for a while and I don't own one yet. I'm looking at getting one this summer. Probably won't pay for full self-driving. Maybe I'll do a subscription if I see the value there. But the response towards 12.3, and Sam, correct me if I'm wrong on this, because you don't own it yet, but you've seen what other people have said and reviewed, has been more optimistic and embraced by the community, even those that were bearish towards and frustrated with full self-driving's progress, more than any other update period. It's not yet like real full self-driving as far as ready, but it's ready enough to where obviously Elon Musk, I don't think out of desperation but out of confidence, is saying, hey, anytime we sell a new vehicle, you have to demo full self-driving with the customer. We're going to roll out it was 1 month free full self-driving for a new purchase.
Let me throw them up.
Throw those up. And each, like when he mentioned that first sell, I'm like, oh man, next is going to come, the free trial with a purchase. And it came like right then. I'm like, oh, sweet.
Here we have the email that Elon sent out at 2 a.m. for whatever reason, just because, saying going forward, it's mandatory in North America to install and activate full self-driving version 12.3 and take customers on a short test ride before handing over the car. almost no one actually realizes how well supervised. I think this was like a compliance reason he had to put that there. Full self-driving actually works. I know this is going to slow down the delivery process, but is nonetheless a hard requirement. And then we saw here from Sawyer, Tesla is now offering at-home demo drives of its new vehicles for Tesla owners. So you had here the ones who had mobile service appointments, they're getting demo drives. Then you also had here this news from Mars around all Tesla deliveries will now receive a month trial for full self-driving. So they're really, really pushing the full self-driving aspect of their business. And I just think that, Elon on his X basically said that full self-driving 12.3, it might as well be version 13. Like, that's how good it is. That's how much of a step change it is in terms of the functionality it provides.
No, I hear great things about it. And what I want, I want to get this update because in my neighborhood, I know of like some very specific areas where current full self-driving just absolutely blows itself to pieces. So I'm excited to get the update and take it through these parts of this neighborhood and say, okay, how have things changed? I hear great things though. It seems like it's performing really well, especially in areas that are frequently driven by Teslas. So if you look at the performance in an area like San Francisco, very complex area to navigate. People traditionally hate driving there, but Teslas seem to be performing great in that complex environment because there's so much training data specifically there.
And yeah, with the full self-driving, it's of course revenues help a lot. Would you throw that up on screen, Tevis? Full self-driving take rate by region. This is Tesla-like order tracker that he has, and you can see the trend. The adoption rate, the take rate was significantly higher, of course, when people had more money pre-COVID and then during COVID, and it's actually quite low right now. There's a lot of reasons for that. Part of it is poor people like me can actually afford a Tesla. And it's not just for rich people like Sam. But reality is this is not great, especially when globally they're under 10% take rate for full self-driving. Part of it too is just a frustration over that. But the more data points that they actually have, the more cars that are driving around with it, that actually helps improve full self-driving a lot more quickly as they go into those niche circumstances like Sam's neighborhood. So with the adoption, like even with the full month trial, like that's good data that Tesla has that they didn't have before. They're not hindered by compute anymore. That was one of the reasons why I think this is being rolled out now. But of course, this will certainly help margins. I can't see them rolling out this if what I'm hearing is remotely accurate with this new update for full self-driving and it not improve this take rate. And so this won't show up on Q1's balance sheet. We're done with that, but it might show up in the guidance. But I think that we'll begin to see that for sure in Q2. So we'll have to see. But this is like really the next growth vector. And between that and them removing some promotions, yes, but actually raising the Model Y price. I know part of that's a lever to drive demand up to Q1, but it seems like they're also signaling that if there are cuts, that they're near the end of those for a lot of the models. There might be more on the premium side. I'm not sure.
And I think
and that's significant.
Didn't they just advertise a projected price increase as well? But maybe it was on the Model Y, or they're planning to ramp this price.
Yeah.
I mean, I'm shocked at how cheap the used Tesla market has gotten. That's really the only reason we got ours is the used prices for low mileage Model 3s is like, whoa, how do you ignore how cheap these have become,
Yeah, that Chris Patel on X was talking about the margins. Basically, he was looking to get into Tesla at 150, basically saying that ever since Tesla was at 230, that it was going to fall to 150, and at that point he would buy in. And the whole thesis was that this quarter margins would be the lowest, and coincidentally, also that's when it would be the best time to buy Tesla stock and the Tesla car, because after that point, the margins are just going to climb back up, and I think people know that, and that's why. I mean, I bought last week at like 160-ish, and that was my first buy since Q1 2023 when I was
good.
So, yeah, I think.
Nailed it.
it's gonna be good for. It might be bad in the short term, next couple of months, but towards the end of the year, I think there's going to be another hype cycle as well with regards to whatever the new models are. Probably going to be a step change there in terms of just the functionality that's provided. We've been seeing the whole like drive-by-wire, steer-by-wire that Cybertruck had. The new Roadster is going to have that as well. And so you're seeing Tesla adopting these new technologies. You're seeing them be able to ramp up production fairly quickly. Mexico is also going to be ramping their building process overall. And so there's a lot of things that are going to happen for Tesla. We're going to get another update on what the bot has been doing. The bot is like, getting better and better every month in terms of the capabilities. So I think there's a lot to be hopeful for, a lot of tailwinds for Tesla going into the second half of 2024 for 2025. But right now it's a lull, and who cares?
Yeah, in Q1 we know is going to be bad. We just don't know how much it's priced in. And the thing with Tesla is every stock is driven by a narrative, not just by fundamentals. If it's fundamentals, like it'd actually be kind of boring and give us a lot less alpha. And the narrative on Tesla was just so low. And that is not always a signal. The bottom things can always get worse, but so many people were expecting and predicting 150. I'm like, I don't know. I'm just going to DCA. If it gets to 150, maybe I'll sell some stuff, a kidney or a kid, whatever, and buy more Tesla. But no, realistically, I'm just going to DCA. If Q1's bad and we get a dump off of that, that's a blessing. I'll take that opportunity to keep adding more unless something is significantly changed. I would be surprised. But yeah, I think that the next vector of growth for Tesla, that full self-driving vector, it's happening earlier than I was expecting before. Like we could actually see meaningful revenues on that, 6, 9, 12 months. And I was thinking that might be 3 years out. So it's a good time.
You guys, considering you want to be long Tesla, you guys ever consider selling maybe some cash secured puts on the name and picking up the exercise if it happens?
Yeah, my problem is I'm basically fully invested at this point, so I got to sell something, and I'm right at the cusp of being able to get those long-term gains with Robinhood. So don't want to do that quite yet. Plus, I think there's more upside there. So when I exit or begin to exit more in my Robinhood position, I'll probably do that. I'll still be DCAing, but I'll definitely do that. I wouldn't mind, getting some larger buys through cash secured puts. But yeah, right now, like I can add, a few shares here and there, and that's it with what I've got on the side right now. So
yeah,
but I'm not selling. I'm being very careful with this and also with SoFi. They're just smashed down so far, and I know things can change in a hurry when that narrative changes. I'm not selling calls on either. I don't have. I'm not even at 100 shares yet on Tesla. Fairly soon, but even if I had 100 shares today, I would not sell that. But yeah, SoFi, I'm not touching that. It just, there's a risk of that. Usually I love selling calls and doing cash secured puts, but yeah, it's a good idea on Tesla. The premiums are there.
Selling calls in a market like this can absolutely bite you, man. It can absolutely bite you.
Yeah, I'm really only doing that on Palantir right now, very cautiously, because I know that stock well and way it tracks, and it's got the large float. And then on miners, just will strategy on miners. It limits upside. It limits, there's still some downside as well, but I'm breaking in. Like the premiums are ridiculous on miners. And so that's just the way I've decided to play it rather than pure options. It's a small position. It's like 2 or 3% of my portfolio. So whatever.
Yeah. I can't. I don't. The broker that I have Tesla shares in doesn't have level 1 yet. So welcome to Canada.
Oh no!
Is it SoFi? Just kidding.
Horrible.
Who do you use, man? If you don't mind saying.
I have a bunch of different brokers. One of them is like a very It's like the Robinhood of Canada. It's this company called Wealthsimple, and they're great. Honestly, great user experience, great app, great UI, but they're new, and so it takes them a while to get all the product lines up. So
is Jeremy Ritter the CTO of that one?
What's that?
Is Jeremy Ritter the CTO of that one?
I don't know who that is.
Okay.
I don't know who that is, Roy.
No worries.
Okay, so do we want to talk about the DJT or do we want to talk about Hood? What do we want to talk about next?
I'm up for
quick note on the DJT thing, man. Is
go for
about this.
I haven't touched. Obviously, I can't touch it, right? But watching this happen was so interesting to me because I've been waiting for so long for liquidity to fold in and derivative markets to fold in on like non-traditional investments. So, okay, let's talk about Bitcoin, right? If you want to trade Bitcoin, well, if you take my role and you want to sell insurance and sell premium, well, you need a two-sided market and you need the ability to sell uncertainty, which we don't have in Bitcoin, but we're starting to get with the equity products that represent Bitcoin. So the DJT thing was so interesting to me because perhaps we're entering an era where the free market will be able to bet on risk and arbitrage associated with political candidates. And that would be such an exciting landscape to explore, man.
It's crazy. Oh, the other thing too is just that I was thinking of is I know campaign finance laws are fairly lax right now, but this feels like another loophole where you can, by buying the stock, and then as Donald J. Trump has, this equity position, and he has, if I understand correctly, some sort of loophole that actually allows him to sell a lot of that position. You can contribute in a very non-traditional way. You probably shouldn't, but look at throw this up real quick, Tevis. I wanted to show this. Just what was the market cap on this? It was insane.
It was SoFi.
So here's the balance sheet. This isn't thousands. This isn't millions. I can't blow it up any further. But yeah, you're looking at $1 million in revenue. It's a meme stock. It's like the ultimate meme presidential stock. It's the most ridiculous meme perhaps of all time. And it doesn't mean you can't make money on this sort of thing. It is interesting, like Sam said. I kind of like it. I'm not going to touch it at all. And I hope that if anyone's in it, that they're making a lot of money off of it. But it's weird.
The crazy part is that I'm looking at it right now. It's $9.5 billion market cap. It's the same market cap. I think it's higher market cap than SoFi.
Yeah, and they made $1 million in revenue. $1 million in revenue in a quarter.
A $9 billion market cap making $1 million in revenue. Tell me what other company in the world could ever reach? It's non-existent, right? So these are products that are going to trade purely on hope and skepticism on the other side, right? There's no traditional investing approach to be had on this sort of product.
This is the Pepe coin or cat with hat.
Yeah,
dog with hat. This is the ultimate of those altcoins. It's just like, oh my goodness. But hey, dude, you got that choice.
It's $2.5 billion bigger than SoFi is.
Oh, that hurts me. That hurts me.
Okay, so what do they even produce? What's the product?
Truth Media. It's a free speech platform. It was DWAC so it's SPACed under DWAC. This is they're officially on their own now. DJT, Trump's initials.
So Truth is like an X competitor, basically, right?
Yeah. I've not been on it in forever. I looked at it
to have a premium version of the social media app where Trump is on, and then that's going to DJT. Like that's the business. Is that
insane,
yeah.
Right? So, and I mean, I see this pivoting away from that. Long term, do I see a successful platform in Truth? Not really. You have X already being developed so heavily and providing the same benefit with a massive user base. I know that there are a good number of people that like to use the Truth platform, but as far as remaining competitive and innovative, all right, now we're not betting on this as a company. And I wonder how DJT will pivot towards trying to incentivize people to invest. What else can we provide other than our revenue from our product, right?
So I had someone who follows. I was talking to them this week, and they said, I can't publicly say this. I can't tweet about it. I can't post about it. But, and I have it here in my notes, they said, I'm investing a couple dollars every week on this thing on principle alone. Like this is them voting with their wallet.
No, that's exactly what it is. They're saying, hey, this guy has a lawsuit with New York City that he needs to pay whatever it is, $175 million in collateral. I mean, when that dropped, like we saw GoFundMe and whatever the other platforms are, one after the other, saying, we're going to give a loan to this guy to pay this, and that's really what it is. It's rallying a political base.
It's just so crazy to me, man. I don't know. I don't want to get political, but like Trump just comes across as like the biggest grifter. Like he literally sold NFTs in 2021 of like him in like a Superman outfit. You know, like who bought those thinking they were going to go to the moon? I don't know.
I have 10. I have 10 of those.
He is a very good marketer, and he markets himself very well. So I'll say that. That's all I'll say about it.
It's insane. So okay, so do we think? I'm assuming there's going to be some way that he can, I guess, issue more stock at that valuation, and then that's how he gets that money to get his ass out of the lawsuit. Is that the play?
I believe his shares are in lockup right now. No,
they are, but there's some sort of clause. I don't remember what it was exactly, but he's able to get out of that early somehow, beyond just like selling collateral or borrowing collateral against his shares, which I mean, there's probably somebody out there that would do that, but yeah, I don't fully understand it. I hadn't looked at it. I'm just like, I can't touch that, but it's amazing and hilarious at the same time. So
let's play a game. If you can't sit on the sidelines, the only two options are you buy DJT or you short DJT. What are you doing?
Oh, buy, because shorting names with you know, a like cult like base is so dangerous, man. What happened with GameStop? What happened with AMC? Like, very similar scenario. You go short on these names on principle. Yeah, it makes sense from a hedge firm standpoint, from an investing standpoint, but don't underestimate people's ability to remain irrational, right?
And the thing is, you know, every stock's narrative driven, like this, certainly. And so I think right now he's ahead in a lot of polls. Like if he wins the election, the stock is going to pump. It doesn't make sense. Like I mean, maybe a little bit, but not really. It's just going to. Inauguration day, same thing. State of the Union address, same freaking thing, man. Like, just
like I don't know. I just like, as an outsider looking in, like living in Canada, that just it makes me smile, because like that sounds like the most American thing, where you guys have a stock that's your president and you can, you know, buy and sell the stock based on what he does. It's just, I don't know, it makes me bullish on like capitalism in general. But I think just presenting both cases. You know, the negative case is obviously, you know, he's going to dump on his shareholders, liquid, like, what do you call it? Dilute the stock and raise money. Like it's going to be like Michael Saylor minus the Bitcoin. You know, he's just going to issue more stock and liquidate. So you would assume that it's going to go down for that. But on the other hand, to Roy's point, he's leading in the polls. And think of how much this thing was going to pump if he wins or when he wins. And then the other thing I have, you know, that comes to my mind is like, how long does this go on for? Like, does DJT just become a $50 billion company? Or like what is the end game here? This is not like a 1-year play. Like I'm buying CleanSpark and I'm going to sell CleanSpark in a year because I know that there's going to be a bear market in crypto. Like, is DJT like a permanent thing that's going to stay in the market now? Because you're not buying it for fundamentals.
It's like, yes, capitalism is great, and you know, I see, wow, what a beautiful market, and everybody buy stock in your favorite president, Donald Trump. This is what's happening, right?
Yeah. The end game is he goes full sailor. It just he starts diluting, buying Bitcoin, and not really, but that would be hilarious.
I don't know. I don't know. It just blows my mind, man. Just the stock market is a casino, and it just blows my mind.
Well, in case like there's somebody sitting in the sidelines is like, yeah, I still think this is like a bear market rally. I don't know who's saying that, but I mean, there's somebody out there. This is evidence, strong evidence to the contrary. This does not happen in 2022. Not at all.
Dude, okay, so first of all, evidence that we're in a bull cycle or this euphoria out there. Number one is DJT. Number two is the picture that Benioff posted on Twitter, where it was like a Colgate toothbrush or whatever powered by AI. Those two things were like, we're in a bubble, guys. Like this is the next bull market.
Not a bubble yet, I don't think, but
no, not yet. We'll see.
It's starting to form just a little bit for years on the end, yes. But you know my thoughts on Palantir, so we won't go there.
No, we won't go there. Okay, cool. So shall we go on to the last piece of news, like major piece of news for this week? Robinhood comes out of the woodwork with their announcement yesterday. Sam, did you have a chance to take a look at this announcement?
Gorgeous, man. I was so impressed by their new offerings. I love to see that Amit was like at the last minute invited to the red carpet event. It was awesome to see. I was feeling so proud of him. And just my thing with Robinhood is I love the marketing. Like Tevis, I know that you're a product guy and that you endorse, like you love what they're doing with the product as well. But for me, I'm looking at this and saying, okay, they're offering something that nobody else is offering. And how are they doing it? Are they what risk are they putting on to be able to offer this? And what is their return on that investment of procuring customers look like? I want to see more details about how that looks like. Are they hinging on, the Federal Reserve staying at the current rates that they're at for an extended period of time? Is that how they're justifying this take, or is it something else? My inherent concern, just from a contrarian take, is I want to know the risk they're putting on to offer these products.
Yeah.
We're going to find out a lot more about that. Amit had exclusive, which I'm sure has to be vetted by the legal team and everything with Vlad. And so I'd asked him like if he had a chance to talk about some of the details on the risks and how they mitigate against that or how they calculate that. And he said that it was broken down a lot more clearly than even in the CNBC interview. But I was looking at it. I think there's only one. So overall, it was a masterful performance. It was, you wouldn't know this, but it was their first live performance of this kind. And I couldn't help but compare this with, SoFi, great management, but they've not done anything like this. PayPal had the first look event, which I understand why it was recorded and why it was done the way it was done. But this is what PayPal investors were hoping for from Alex Chris, a celebration, that sort of party atmosphere, and you're launching all these exciting targets in a Steve Jobs-like way. It wasn't done. Expectations and reality didn't match, and we saw what happened with the stock. That's short term, that's just noise, but still, Vlad and team did just a phenomenal job with that, and it was just one thing after another. So just small things like, well, not really small. So the 1% match for everybody is actually kind of insane and huge. And that's one, like we can take this like one piece at a time, but
Sure.
That's actually good enough for me that once they roll that out, that'll be in May. It's not available yet. I'm moving my larger portfolio position over to Robinhood. Like I think it's on matches, if I understand, not just new contributions. And if so, like it makes sense. Now, the way that they've structured this, and it wasn't clear from the announcement, but if you read the fine print and look at that, you don't get the 1% right away. So the bear case is certainly beyond just risk, which we can talk about as far as the credit card in particular, is that the cost of acquisition is high for doing things like this. But if you take that 1% and you divide it over a 24-month period, that's 0.04% per month. That's not a substantial upfront charge. And if they withdraw their money before the 2 years, they can. They get to keep what they got. They don't get to keep the rest. And as people add more and more money onto the platform, then that moves that 24 months further and further out. And so they get hooked. They get addicted to the Robinhood UI. They want to do everything through Robinhood. That's the vector they're going. So I thought it was actually ingenious of the way they did that. So that part, I don't think there's really any risk there. I think it's very unlikely that somebody's just going to put money in and not do anything with it at all, period. There will be some of that, but even with cash sweeps, they make enough money. They make 1% per year. So they would more than make up their money for that over 2 years.
Look, they're basically doing it the way companies issue stock, and they're just doing it with money instead of stock. Like if you guys have ever worked for, a software company, how it usually works is you get stock over a 4-year period. 1 year is the cliff. You can't leave within that 1 year, but after that 1 year, it vests every month. So it's like 1/48th of the amount. In Robinhood's case, let's say I'm going to get 10 grand. I get 10 grand over 4 years. Then, whatever, I get $2,000+ every year until I earn that out. The thing that happens with companies, though, and this is firsthand knowledge for me, they don't stay for those 4 years. They just keep moving and they collect whatever it is for 2 years or 1 year or 3 years, and they leave. And so ultimately, it's going to come down to how good is their product offering to make, let's say, Roy in this case, that's going to transfer all his money into Robinhood. They have to incentivize Roy consistently to stay with Robinhood over that entire period of time. Regardless, like Roy's not going to stay because, oh, if I stay for another year, they're going to pay me another $1,000 or whatever. Like if there's just a better product in the market, and if you get, something better, like you will leave. Currently, there's not really much that's better out there. But I don't know, in 2 years, like Vanguard might come out with something, or whoever might come out with something for high net worth clients that could offer something similar. So I agree. It's a smart move, super smart. I love the product offering. I was pretty clear about that. I think it's also a smart move to mitigate their risk, to spread it out over several years. I'm just saying, like trying to be neutral, that you don't know what's going to happen over that same period of time. People might still leave halfway through because the market landscape might change as a result of this new product that was offered. Like Robinhood threw down the gauntlet for SoFi, but they also did it for the entire market, right? Everybody is going to be flooding all of their money into Robinhood. You'd have to be crazy to think that nobody's going to respond to this with offerings of their own of a similar nature.
No, that's a great point, man. Like, so me personally, on the 3% match, I transferred my entire IRA to Robinhood to get the 3%. Now, what stops me if SoFi comes around and offers a 3% match next year when I've already used Robinhood's? What keeps me from saying, oh, I'll roll my IRA into SoFi and get another 3%? Like, why wouldn't I do that?
5 years, 5-year lockup. That's what.
Is there a 5-year on the IRA roll as well?
Yeah. You have to be a Robinhood Gold subscriber for a year, but you have to be on the platform for 5 years. And so they basically did the same thing, as far as that rollover, but instead they paid the upfront cost. And it was actually kind of interesting when their Q4 numbers came out. I was actually thinking there was a chance of a miss, and I was ready to load up on that freaking dip. It didn't happen. And I thought it would be the acquisition cost that they were paying upfront for this product, but it didn't play out that way. So we'll see some of that, but they're setting up for long term. And to Tevis's point, I think the thing is their user interface is phenomenal. The Robinhood Gold tools are pretty interesting. Like what they actually offer, it's hard to compete with that. And they're not just going to sit still and say, hey, we're good enough, we're going to stop innovating. That's not who they are in their core at all. The other thing is, like, which I thought was very impressive, was that user interface that they showed off. It was hard to get screenshots of that, but I'm like, okay, so that's one of the things is, like, I'm not a new investor or trader, anymore. Like, it's good enough, as far as the way, and you could tweak it here and there. It seemed very customizable to be able to do exactly what I need to do at a glance. And I use it anyway. So I'm like, hey, there's no reason for me just not to shift over and be like 95% in Robinhood as far as my, my individual portfolios. So
let me backtrack a second and ask you, Roy, on that lockup period. They can't make you sign. Well, I'm assuming they're not going to make you sign any documents where you physically can't move your money out of Robinhood for that period of time. It's just
right.
You can move your money. If you do move it, you lose out on the benefits. So to Sam's point, let's just say that, and Robinhood is skirting such a thin line here with regards to liquidity, default ratios. Like, they're betting the farm on this specifically. Let's say that Robinhood rolls this out and all that liquidity flows into Robinhood and everybody's waiting for that 5-year vest, right? They're all waiting for their money to vest in 5 years. 2 years in or 3 years in, SoFi, Ameritrade, Fidelity, Vanguard, Schwab, whatever, one of them comes out with a 4% change. All of a sudden, Robinhood could have a shock to their system where so many people leave to chase the next highest yield, and that could cause liquidity problems for them down the line because there's no enforcement mechanism to keep people on the platform. It's just an incentive, and people will flock to whatever's the best new incentive in the market. I don't know. That's just like
disagree. I disagree completely.
I can see both sides, right? Like, so from my perspective, like the first time I used Robinhood, I think was in 2015. And even at the time, they had the most retail friendly platform. They're clearly talented product people, like no doubt about it. Right. But I'm going through my transfer paperwork right now, and I'm not seeing that there's necessarily a restriction on basically them like you know, taking back the match that they gave me, because how do you take that from an IRA, you know? But I think that, yes, if you want to keep exploiting the 1% additional match, whatever you add to your IRA, I can see them removing that capability. But as far as another brokerage, it almost feels to me like Robinhood is saying, hey, we've got a small window here where the Fed interest rate is high enough that we can offer this. Let's put all of our eggs in this basket, get as many customers as we can, and then hope the Fed comes down so no one else can match it, right, and steal our customers. What do you think there?
I think that's partly it, but throw this up real quick, Tevis. I got this today. They are not offering the highest rates. They're not. This is Webull. It's a 4.5% conditional match on IRA contributions and transfers. It's really 3.5% if you read the fine print. There's limits. There's all sorts of different things. If you look at uninvested cash, Webull also beats them on that. Typically with rollovers and stuff, it depends on the time. Webull beats Robinhood on that. Are there people flocking to Webull right now? No. And I use that platform. That's my main broker right now. I know there's some risk with that. That's one of the reasons why I'm looking at Robinhood. They have incredible charts. They actually have the best charts. They have a lot of good features there. The options are there, the margins and everything. It's done well. Apex Clearinghouse, good. They don't really have crypto. They're not as good as Robinhood. And there's a reason why people are flocking to Robinhood in droves. And so there's a point where, you know, it just offering better rates is not good enough, that people actually want a product that comes with that. And they love, people generally, not everybody, some people still hate Robinhood,
Right.
but most people love Robinhood. They find it an incredible platform. And that's really what they're trying to do. I think you're right, Sam, that they're trying to take advantage of this higher for longer period. They're like, hey, we're printing money right now, and they're cyclical. So they're printing money in this cycle, absolutely. And they're saying we can set ourselves up long-term through the IRA match, through going after the gig economies, through this 1% for everything match. And as people, we believe that as people try our platform and as we roll out new products, as we continue to innovate and we add all these gold features, which are exclusive and unique to us, or you have to pay a lot more money for separately on other platforms, that people will find value in our platform and they'll want to continue to use us in the future, even after that 5 years. So in Tevis's example, you have the 5%, let's say in 2 years, public says, hey, we're going to give you 6%. There will be a few people that move over, but you're basically, I know it's sunk cost fallacy, but you're basically going to be pulling out to go after the 4%. There's going to be some sort of conditions and lockup period for sure, like there is for this Webull thing. And you got nothing for your time in Robinhood. They don't pay that incrementally. It's all at once up front, and you lose it if you leave within 5 years.
I think, Roy, fundamentally, the two camps, as I see them after hearing Sam and yourself, is I heard one argument was Robinhood is basically bribing people to come onto their platform. And we could make that argument. Yeah, we could make it. The argument that you're making is Robinhood just has a superior product. And by that, I want to stretch that out to say, even if Robinhood offered a lower dollar value, people would still flock to Robinhood just for their product value. And so if those are the two camps, like those are the two extremes, right? I could see like one of you shaking your head and then the other one shaking your head. And so those are essentially the two camps. And Robinhood is something in the middle. They offer a great value in terms of the actual dollar benefits, but they also offer a great product. And so what I'm saying is when pushed to the extremes, when the market dynamics change, which one of, like, that's when we're going to find out where the majority of users sit on that scale. If it's like pure product, then they're not going to budge because they just love that user experience and that's why they're there. And the offer could even be lower for Robinhood and they would still retain a high amount of their users. But if it is the, you know, we're bribing users, I'm here to get the $1,000 back in my pocket, then I am going to go to whoever pays me more. And Robinhood might see a bigger shock to their system. That's all I'm saying. It's like this thesis is really only put to the test when other market incumbents start coming out with their own novel solutions as a response.
If they do, not when.
If they do, absolutely, yeah, sure.
And there's really two people that use Robinhood. In 2020, it was basically poor degenerate gamblers that were new to the market. Not everybody but that was like 90% of people, maybe, like just making things up.
And you think these poor degenerate gamblers, like that cohort of people, are going to have the patience to think about sunk cost fallacy? No, man. They're going to see that big sticker number, 6% versus 4%. 6 is bigger than 4. I'm jumping, baby. Like,
no, what they see is confetti. They see freaking confetti, and you know it.
Back to the product.
That's the degenerate gambler. The cheap options you can trade all day, like the 24-hour stuff.
Sure.
That's addictive. It's absolutely addictive. Others will copy that. Sure, I know that.
Sure.
Vlad, even like in the CNBC interview, he was pumping the 24-hour trading. He's like, they're like, oh yeah, Robinhood's up at this price. He's like, no, we have 24-hour trading, and we should give that to you guys so that you can actually show it sponsored by Robin. You know, it's just like, yes, Vlad, go Vlad, pump my leaves. But
I get it, man.
No, like the other side is that they're really bribing are those wealthy investors that aren't actively day trading and they're not, doing much with options. Those are the people that they're bribing with this. But, there's a reason why those people are not flocking in droves to Webull, even though Webull has more money. It just, you actually have to trust and like the platform, and it has to have the features that you want to do. And that's what Robinhood is. And that's what they're able to offer. So they're building, not just what they're trying to do is capture this momentum in the crypto space, well, with the golden confluence of events that are helping Robinhood, with the products that they're launching, with the massive cash that they have, with the higher interest rates, and make it so that, like SoFi, they're a little more resilient in those downturns, that people won't necessarily be pulling off their money in droves. I don't think in 5 years people will say, you know what, I'm leaving. I mean, there will be some, but a lot of people just stay on the same platform, even when there's better offers out there.
I'm just trying to play devil's advocate, right? Like, I'm very, very bullish on this, and I have no position in Hood. So it's completely like from a pure product perspective, because that's the industry that I play in, that I'm really like, wow, whatever I have against Vlad personally, I even said in my post and in the video that I made earlier today, like, kudos to him and the product team for actually capitalizing on something novel and groundbreaking that they introduced, because it's something that is very much in line with their core DNA as a company, with their mission statement, with their user experience. Like, everything, sort of the story is all there to support the narrative. And that's why it makes it so sticky when they're offering these things, because they can justify it by saying, hey, this is who we've been all along. Now, if we have another GameStop situation, then that's going to get tested, but you get my point.
Yeah, he was asked about that. Go ahead, Sam.
Sorry. Yeah. So no one can argue that Vlad, like, I'm a big fan of Vlad, and his product team is stellar, man. It's absolutely stellar. When I see this happen, though, I always get sucked back into the idea. Like, watching his CNBC interview, I was a little underwhelmed by his answer when the reporter asked, hey, like, you're offering this and almost no one else, like you mentioned Webull is, but, for large majority, no one else is really offering this. And she asked him, like, what does your risk look like? What are you putting on here?
Right.
And his answer was basically, well, it brings people into using our other products, and that's good for us. So I get it. That's good for Robinhood. But as an investor, I don't have a Hood position. If I were to put one on, I need to see what they have on, man, risk wise, and see if it's something that I believe will work out for them in the future.
Yeah. So with the credit card platform, and throw this up if you don't mind, this is a Visa signature, not signature preferred. I got to figure out how to make that bigger someday. But it's real tough to see. You can pull this up. I've got it on one of my most recent posts. So basically, they're making off the Visa signature 1.5% minimum plus change. And that actually, Vlad said on the CNBC interview that that's actually going to them. So that 3% that they're offering, you can basically think that they're offering half of that. So 1.5%. That needs to come somewhere. And the way that the rewards are structured, there's 3 different types of rewards. Really, the only one that hurts Robinhood is specifically if someone gets cash and then they cash out, they send it over to Robinhood's platform and they cash out immediately. But historically, at least, most people, when they get rewards of some kind like this, they spend it, they use it, they change it over for some sort of like gift cards or something like that, or it's fun money, and they throw it in 0 DTE options and just watch it go to nothing, because don't do that. But no, that's more likely than not the way that's going to be played. It doesn't mean that they're going to make money on every single consumer. The real risk that I see is in the default rates. Like this, they bought out the X1 platform for the credit cards, and it seems like their default rates were fine from what I can tell on that. This was back in 2022 though, so it's harder to or 2023 rather. So things have changed a little bit. Default rates are a little bit more, and that's one of the things that's killing SoFi is they have not done well as far as their credit card for that reason. And so the way that they were talking, which concerns me as a shareholder, and I love because I want to own the card, but like as a shareholder, I'm like, I'm not sure. They're saying they don't actually run a hard credit check. They do, I'm sure, a soft credit check, but basically through their partner, Coastal Community Bank, something like that. I can't remember the name. I've got a post coming out on this after the Amit interview because I want a little bit more information. They basically are the issuer of the card, and so they run the checks. I'm seeing on their credit card platforms a 14 point something% annual help me now. It's not default rate. It's charge off rate right now, which is not good. That's not the X1 or the gold card. But if Robinhood, who says that they want to make sure that most, if not all, gold subscribers are eligible for this, if they go that route, there is considerable default or charge off risk here. So we'll have to see how they mitigate that. That's the real danger. They do have an escape clause that at the very end of the legal document, it says something like Robinhood at any point, like for a 60-day warning, they can change the reward structure. And they may have to do that. Like, honestly, it's an incredible card. The benefits are really, really good. There's an annual fee like the Robinhood Gold, but I question how they actually control the charge-offs if they're using this as an issuing bank. And the other piece, too, that I'll give you real quick is the issuing bank bears, I believe, zero risk with this. They have the banking as a service platform, and all except for one of their platforms assume that their partners assume 100% of the charge-off risk. They have one where they take 10% of the risk, and on that one, because there's too many charge-offs, they even adjusted the way that they would authorize those ones. So the risk, I believe, unless Vlad comes out with something different, is all on Robinhood. And this is not in their wheelhouse. I mean, they have somebody from Nubank. They have the X1 platform, but it's like, I don't know, guys. We'll have to see. But that's the best thing about being in Leaps and this being a short-term position is that might not hit on the downside until I'm out of Robinhood, and I'll be like, hey, maybe it'll work out. If so, incredibly profitable. But there is some risk here, more so than the other things that they mentioned, which I think are all phenomenal.
Look, I just want to say something, and then I'll let Sam jump in. But their stock was up, what, 5, 6? It was up 10% in after hours at some point, and then it closed pretty flat today. Like up 2%, 3%,
5 or 6. We closed at 2001.
Yeah.
So
yeah,
3.79.
All right. So
okay, that any day. That's flat. Give me flat.
No. Sorry. It closed up 4% from being up 10%. Great. My point is it pulled back from overnight trading. And I think the main question that was coming up was, how is Robinhood going to afford this? I said in my video earlier today, they are betting the farm on this. The announcement that they made, the benefits that they're offering, just the whole presentation value alone, they're putting a lot behind this. And the thing is, we have SoFi as a case study. SoFi has been struggling somewhat with their credit card division. Yeah. So, you have the overnight trading. Cool. So they're up in overnight trading. SoFi has been struggling somewhat with their credit card division. They have default rates in the teens. They're investing $100 million, a year to basically grow that division out. And credit cards are not easy to do. You have to really nail down the numbers, the FICO scores, the income rates, the default rates, charge-offs in general. What I saw in the demo is I saw this guy get approved and have, in 2 minutes and have a card shipped to him in a couple of days. I also wanted to bring up this comment. Apple tried this as well, and they had trouble as well. We haven't really heard news about this. Nobody's taking on Apple. Remember when, it was going to be Amex, or who was it going to be? We haven't really had any new news. My point is that the worst thing that could possibly happen for Robinhood is them realizing they bit off more than they can chew and having to add some clauses, some fine print to this benefits, or even retracting some of those benefits in general, or even discontinuing that card, because that is going to hurt the brand way more than the boost that they got from introducing this new product line. there's a lot of expectations on this new product line, and the worst thing they can do is backpedal. And so it's a pretty risky game for Robinhood right now. Initially my gut response was, I want Anthony Noto to respond with what is SoFi doing to combat this. And then after I had 24 hours to digest this earlier today in my video, I said, I don't want really Anthony Noto to respond to this, because I want him to see first how it plays out for Robinhood. If Robinhood is saying, if they're burning down their own business to try to fund this product, I don't want SoFi to blindly follow them into that and get into a war of attrition, offering more and more benefits. You have to understand, the more benefits that you offer to your users, that's the less profitability you have as a business, and it hurts you from your investors' perspective.
Yep. The thing that circles back to me, man, is when you come to lending products, right? We've seen time and time again the inability to, accurately define your risk melt companies over and over again. If you go back and look at 2008, there's a famous interview of this guy who was selling mortgages at the time, and he's saying, I jump on the phone and I say, okay, what's your name? And all right, you're approved at $600,000 mortgage, all good, man. And almost, I'm tempted to almost feel like we're seeing this in the retail space, which is why I'm hesitant to kind of buy into the hope here, is because the risk management and the risk assessment industry within banking is huge. And these are some of the smartest mathematicians that jump in and model this risk. Who does Robinhood have on their team? Because they're new into the product space, right? They're jumping into this, they're jumping into a deep pool head first. And what do their risk teams look like? What does their risk assessment look like? Can I buy Robinhood at $20 a share? I'd love to hear your guys' thoughts. If Roy, it sounds like you're long Robinhood. I'd love to hear why you want to stay long here, because I run, you guys have seen my valuation analysis for several companies. I run this on Robinhood. I see, based on current growth rates, $15 valuation or so here per share. So we're banking on explosive growth to justify the current increase in price. So what are you guys' thoughts there?
And we'll see explosive growth for sure here. Credit card platform, my guess is it's probably close to revenue neutral. I think they're taking on risk that there will be a lot of people, they make it from both the interchange rates and the lending. But as far as me being long, I'm long in leaps. So January 2025, I'm completely out. It's cyclical. There will be another down cycle. It probably won't happen for most of 2025. Who knows exactly when, but it will start. At least interest rates will be falling, and that's one of the big pictures and pieces. And we'll see if they can offset that. But down cycle, I might go long with them at that point. But as far as who they have, so they bought the X1 credit card platform, and this was a Max Levchin backed card. He and a firm handled the default rates. They actually have ridiculous default rates and a lot of success with that. And I've questioned that, and I've been like, how can they be doing this? What sorcery is this? But reality is there was some talent that was injected into that company when Robinhood bought it. I think is still there, if I'm understanding correctly. And they also brought in somebody. I was looking for the name. I couldn't find him. Vlad mentioned him in one of the interviews over from Nubank. And Nubank, do you know much about Nubank, Sam? I know you do, Tevis, because Tanner. Nubank, so they're operating in Latin America, and the challenge there is there's not FICO scores. They don't have that. And so, I asked Tanner this. I said, because he's big in Nubank, and that's one of the companies that I'm interested in maybe starting a new position later this year. The way that they handle that for people that don't have any kind of credit at all is they will give you kind of a trial card. They'll be like, we will be glad to approve you. Here's a card for $150. And you know what? If they default on $150, fine. No card. We're going to take that away from you. And that's worth the risk. But if somebody proves faithful with that 150, they're basically building their own credit score. Of course, they have similar profiles as they move into Mexico, as they move from Brazil. That kind of helps their algorithm a bit. But they're developing their own FICO score, essentially, with individuals. If Robinhood, if under Nubank, this guy from Nubank's guidance is that's what they're doing. They're saying, we want to prove everybody just, the status symbol and everything. And that some of these people that have abysmal FICO scores, or they don't seem like that they would do well with it. If they give them $100, I have no problem with that. Like, that's fine. They default on 100. Robinhood has almost 7 billion in cash and no debt.
Okay, but
So
they're
but
not
I
going
don't
to give anybody $100, Roy. Like, it's not Latin America. Like, so okay, sorry to interrupt, but like even SoFi right now, one of the biggest complaints is that they have low limits on high earners. Somebody coming in making 200 grand, like TJ opened a SoFi card and they gave him like a $8,000 limit, and he's like, dude, what do I do with, like, what is this? You know? And if you're making like $500,000 a year, there's no reason why my limit should be, 10,000, 20,000. But they do that as a way to mitigate risk. Like Robinhood could do that, but still, like SoFi is dealing with high FICO. Like SoFi has the bells and whistles, the checks and balances in place to make sure that we don't have, people defaulting, and they're still seeing defaults. And so now I'm looking at Robinhood offer way more benefits than SoFi does, and we're expecting lower default rates. Like I just don't get it, regardless of how high or low the limit is.
Yeah, I'm definitely curious to see how the limits look for this card rollout. I mean, what are they going to do as far as individual risk assessment? That'll be really interesting to see, man.
I honestly think that what they're going to have a loss leader in the credit card, and they're just going to make it up in the back half. They're probably going to sell data to Citadel or others, or they're going to push to have more referrals on the trading side, or there's going to be something around the trading side of the business that makes up for all of the losses of the credit cards. And the credit cards are essentially going to be like a top funnel, funneling more people into the brokerage side of the business, like as a loss leader in their business model. That's like what
See, that model scares me, man, because the instant you have a meltdown market and you have pandemonium around lending products and the default rate goes up and people are going, hey, I can't pay my bills, I'm going to default on this card. What does that do to Robinhood as a company? It could be dangerous. I'm not saying that it will be. It's just something that we need more information on, I think.
Yeah, I'm hoping that we get that. I'm waiting on this piece just for that reason. I think that we might get those pieces, or at least some of them, in Ahmed's interview with Vlad, because you mentioned asking him some of those similar questions and getting a whole lot of details. Let me share this. This is Coastal Community Bank. This is from their end of the year document, the 10K. And you can see down here the net charge-offs. Yeah, this is their credit card platform, the banking as a service, 14.88%. And that tends to be trending up. So I have concerns with this, not with the other products. It may be a loss leader, not ideal. And I'm saying if, I don't know for sure, but if they manage to mitigate this risk well, and Tevis, you had a good point as far as like the low amounts, but if they're like, hey, some dude, they're going to pay it back, no problem, give them a 50,000 limit, great. Right. If it's some dude that they're going to reject anyway, give him $500 to play with, see how he does. I'm fine with that. They might lose some money there. I don't think this is a bet the farm, like you were saying, though, like in the sense of if this doesn't work out, Robinhood's dead. It will hurt them for sure. And it could, more so than the other products. But yeah, this almost 15%, and things seem like they're getting worse, not better as far as default rates. That's not good. Not good at all. So we'll have to see.
I think it's a bet the farm from a perceived, like a business brand perception point of view. Like they're calling it Robinhood Gold. They're aligning it with their mission. They're saying, oh, you can, have family members. You can, like, they're assigning so much of their business values on this launch. And for them to be like, oh, sorry, guys, didn't work out. Bye. Like a lot of people are going to be like, what the heck, because it's it seems like, core statement, such a core offering to their mission statement and to their value proposition as a business. And so it's not like, oh yeah, SoFi's, offering whatever, Expedia benefits for their users. It's like, no. SoFi's offering student loans, or whatever it may be. There's a big difference there in terms of what is the brand promise and what is that mission statement and those values, and how does that correspond with the product that you're launching. And that's why I say it's betting the farm.
So is the day that Robinhood offers 30-year mortgages the peak bubble, or what?
Third year, yeah, I don't know. 30-year mortgages for Robinhood is like, I wouldn't be viewing that as highly as I view the credit card, because like this is more in line with like more tangential with the broker side of the business. I don't know. Maybe I'm just making this shit up, but what was the last thing I was going to say about the Robinhood card? I forgot.
Yeah, we might talk more on this in SoFi Weekly. I'm sure that we will, but this is, I don't know about the credit card. The card itself, you thought of it? Go for it.
No. So I was just going to ask you, Roy, like, what is the actual percentage on it, the APR? Because like the other way I'm trying to justify it in my mind. How can they make this profitable, right? And one of the ways is if the brokerage side of the business is carrying the weight. The other way is if they're charging people who default like 30%, 40%, like something astronomically high that, you know, other credit cards don't, then yeah, they can probably make it off of, you know, to have it as a viable business model.
Seems like Roy has an answer in mind. I was going to say it's got to be high 20s to make it work, man. I mean,
yes, yeah,
I would say.
Check this out. So, yep, 20 to almost 30%. Balance transfers, same thing. Cash advance, 30% right there. Penalty, yay, none. You're paying enough. Due dates, minimum interest charge, none. Annual fees, none. But I mean, it's Robinhood Gold. Return payment up to $40. Replacement card fee, not free. It's $40. I mean, it's gold plated. Late payment, $29 for first instance, $40 for the next instance. And calculate value APRs by adding a margin of, this is their margin, 11.74 to 21.49%. Those are some sweet margins. But if they don't manage that downside risk with the charge-offs, it won't matter. This will not help them. If they do, like, credit is a phenomenal product as far as a business. They'll make a drove of money off of it. It's a big if for me. And it's not a risk that I think investors should overlook.
I know most oh, sorry, go ahead, Tevis.
No, please.
I know most retail investors maybe don't think this way, but if you're someone who doesn't pay off your card balance every month, despite the 3% match across the board, this is probably the worst card you could get.
So exactly. And I saw somebody saying like, you know, that's market average these days. I don't know, maybe I'm getting old, but market average for me is like 16 to 18%, 16 to 19%, around that range. 29% is freaking crazy, man. So that's one thing. Like, that's one thing that they can do. Here's, I think, the most genius thing that Robinhood could do. If they have it where if you don't pay your card, we're taking that 30% out of your brokerage account, similar to how it is for margin, then I would open a position in Robinhood and bet a lot of money on it, because it's backed by the brokerage account. Then it's like a no risk introduction for their credit cards.
No, I mean, I've got an Amex at, I think, 17.5%. But yeah, like, you're looking at, hey, that you default on this card, and now we don't have to go through the debt collection process because we have access to your funds already. That reduces the downside risk for sure.
And Not a Lurker said, you know, it talked about, are they crazy? Those are really high APR rates. It's not normal. Unless you're transferring money over from one card to another, you're not looking at APR rates. If you're getting a credit card, you're looking it's a status symbol, and then you're looking at those sweet benefits. And you're like, yeah, of course I'll pay it off every month. And if you do, it's one of the best cards out there. If you don't, it's one of the worst cards out there. So, by the way, my referral link, if you're one of those that you're not going to pay it off every month, please don't click that link and give me the gold card. Like, I don't want you to be like gouged like this, even though it'll benefit me as an investor and I'll get the card. But if you pay it off every month, I mean, take a look at it. It's an incredible product. I don't know if it'll work out or not. They have the escape clause as far as the rewards, the way it's structured. And if you didn't see the video, what did you guys think about like that instant conversion of the rewards there? Like, that was amazing, I thought. Very attractive.
Beautiful demo. I will never fault them for their ability to market their product. It's gorgeous.
I'm a shit. Yep.
Guilty
exactly. For this.
If you say nobody cares about the APR, that's when I'm like, okay, Roy wants a gold card really badly, because maybe Robinhood's core demographic doesn't care about the APR because they're all like 22 and want to flex to their, you know, when they're on a date, they want to drop a gold card because they, you know, they feel like they made it like that. But come on, man, I care about the APR. Fucking Tanner goes APR hunting. Like, he looks at
not normal. You're
What?
not normal. You're not the demographic for Robinhood. Like, think about their customer base. Most of these
Exactly.
people are
That's what I'm
either
saying. We're agreeing. I'm saying the customer base does not care, but
you're
you
not
should
them.
care.
Yeah. So again, the two customers are filthy rich people that like status symbols. So that works out. Degenerate gamblers that also like bling. That also works out. That's their customers. It's not the Tevis and Tanner. They don't care about freaking Canada. I'm sorry.
So, Roy, I would love to hear your thoughts on this idea. What if the credit card defaults were insured by the brokerage side of the business? Would you still get a credit card? I mean, you probably would still,
Oh yeah. Yeah.
but
I'm paying it off every month. So
if I have a brokerage account, it would operate the same way as margin does. And if I don't pay my credit card, they can go into my brokerage account, sell some stock, pull that money out.
yeah, it would probably, I'm sure there's some legal way that they could do that, but I would prefer that they don't do that until like maybe 60 days in or something like that. Just, if somebody's a day late and then you force them to sell a position, people are going to get mad. So give them some grace period. That's all I'm saying. Like I've even forgotten before. I hated it because it's like freaking late fees and stuff. Normally I automate those, but sometimes something happens. But I think that would be a sensible, smart thing. It would mitigate a lot of the risk for them. They don't want to push that lever probably just because it is reducing assets under custody and possibly even losing a customer, but they might. And it's interesting. Like it would make me perceive there being less downside risk, and there is definitely some of that with the credit card.
Yeah, time will tell if it's successful or not. Some people were really panicked. SoFi investors, SoFi bulls that I know. Other people were really annoyed, frankly, that I even put Robinhood in the same category of comparing it to SoFi. They do overlap in the credit card segment. If I'm in the market to get a new credit card, I'm going to look at SoFi. I'm going to look at Robinhood. I'm going to look at Amex. I'm going to look at whatever it is, and I'm going to pick one, and that's who I'm going to go with, and that's the company that's going to win my business. So to that extent, SoFi and Robinhood are competing. Of course, I'm not discounting the fact that SoFi has a full ecosystem of other products and Robinhood has this other entire brokerage side of the business. All I'm saying is it's a pure product offering that is superior in the market in terms of the benefits that they offer. And if I was going to go to SoFi credit card yesterday, maybe today I might think twice about it.
That's totally fair, man. I mean, they're absolutely overlapping on the credit card business. Now, what does it look like, for moving forward? Is this going to be an offering that they can maintain if the federal rates come down? Why hasn't SoFi done it yet? SoFi has a good product team, so what is SoFi seeing on their side that's saying, I think we're going to hold off on making an offering like that,
Well, credit card is like one of the irons that they have in the fire, and it's their smallest, business, one of the smallest business segments that they have. It's something that they're actively working to increase. It's not their core focus right now. Their core focus is other aspects of their business, their bank side of their business, their checking and saving side of their business, so on and so forth. So if credit card was a bigger slice of the pie, then yeah, maybe they would have focused on how can we make these benefits better. But what have we been seeing over 2023? The APY increase on the checking and saving side of the business consistently, the 4.6.
The other thing that I thought was really interesting with the credit card, I'm sure there's others. I haven't gone credit card shopping in a while, but being able to build credit for any age, like you can give a card with a like $50 limit to your 11-year-old when she's going out with some friends at the mall, and that's building her credit. That's amazing. That's great. And then the fully anonymous virtual cards, where not only do you have a virtual card number, but also a name if you want to keep your purchase private. People want to do that. It's a real concern. I'm sure there's other innovations that other people are doing, but man, it's Robinhood. Like they're going to keep adding features, bells and whistles. So it's a compelling offering. I think it's better than SoFi and PayPal's cards for sure. But I don't know, just like you guys are saying, that it's better for Robinhood than, well, the card's not doing anything for SoFi, but than PayPal's card for PayPal.
Right. Any
Dangerous.
last things to add on this topic, or we want to move on? Do we want to wrap here? How are we feeling?
Totally up to you
Wrap
guys,
it.
man. Yeah, all good.
We want to wrap here? All right. Well, thank you everybody for joining. Sam, thanks for joining. We really enjoyed having you on the podcast.
Dude, thank you so much for having me. This was a blast. First time jumping on a live stream, and I'll do it anytime with you guys in the future, man. Very fun.
Everybody
Nice.
goes follow Sam. His handle is right below, right beside his name. Post some great DD on X and sub and like. We do this every Wednesday at 9 p.m. Let us know in the future what topics you want us to talk about. We sort of just go through the news and whatever sounds interesting we'll talk about. But yeah, thanks everybody for being here, and we'll catch you on the next one.
Cheers, guys. Thank you so much.